Hello and welcome to episode 73 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamelin. Today, we have some exciting developments to discuss, especially for those of you who are first-time homebuyers or are working with them. We'll be diving into whether prospects are improving for first-time homebuyers in Canada. Canada's housing market may not be roaring back just yet, but a surprising upturn in fortunes for first-time homebuyers is presenting room for optimism looking ahead. And with it, there are also opportunities for mortgage brokers. RE/MAX Canada's Fall Housing Market Outlook revealed that 25% of Canadians are not only actively saving to purchase a home, but they're also confident about their prospects in doing so. A sizable percentage of that group, 35%, is made up of younger millennials and Generation Z buyers. High rates and affordability woes have long bedeviled first-time homebuyers, but the real estate giant's president, Christopher Alexander, said their latest findings point to potentially better times on the horizon for many new buyers. This, of course, means new business for brokers. That's especially the case with interest rates recently dropping and new inventory hitting the market in some prominent urban areas. For a prolonged period, those demographics were giving up, Alexander told Canadian Mortgage Professional. And now there's some renewed hope, which is really encouraging, because the first-time homebuyer kind of starts the cycle for the different market segments. Optimism may be on the rise, but that's not to say the affordability crisis has improved dramatically as a result of falling interest rates, either for current owners or hopeful buyers. 14% of current homeowners say they need to renew their mortgage soon and may need to sell their home because of the present high rates, according to the RE/MAX report. Saving for a home purchase has also fallen firmly behind daily expenses such as utilities, food, and travel in Canadians' current financial priorities. Still, lower rates on both the fixed and variable sides are pointing to an encouragingly steady market in the months ahead. RE/MAX said green shoots were appearing amid a flurry of rate cuts by the central bank, and most regions are likely to see sales price growth from 1 to 6% before the end of 2024. Alexander said plenty of positive signs were appearing for the nationwide market, but cautioned against expecting too quick a recovery. Affordability is slowly improving, at least in the housing sector because of decreasing interest rates, but we still have a ways to go before we get a lot more consistent market activity, he said. Consumers may have plenty of choice in the current environment, Alexander said, but slowly but surely, that available inventory is going to start to get eaten up or consumed, and we're going to be back to a very competitive marketplace, probably in the second quarter of next year. Against the sluggishness of the overall mortgage and housing markets in recent years, it's easy to forget that housing starts have also failed to pick up substantially, remaining well below the level viewed by Canada Mortgage and Housing Corporation as necessary to restore affordability by 2030. That could spell trouble if the market rebounds as expected by RE/MAX. Unless there's a big spike in acceleration of building, there'll be a limited amount of time consumers have, Alexander said. I do think, though, with the rates the way they are and the cost of living, not just real estate prices being so high, that if we do return to very frenzied bidding wars, I'm not so sure we're going to see massive leaps in pricing. But mid to high single digits would be welcomed by most. Bank of Canada. Governor Tiff Macklem believes that while rental prices may decrease due to falling mortgage rates and more supply, home prices could still rise. While rate drops may have strengthened hopes that a market resurgence is around the corner, Alexander noted his surprise at predictions of a continually tepid market for Kitchener-Waterloo, heavily driven by the Greater Toronto Area. What's more, a strong majority, 77% of Canadians, expressed a belief that the steps taken by governments at all levels are insufficient to solve the national housing affordability crisis. That comes as little shock, Alexander said. The key is, we still don't have a national housing strategy that involves the 3 levels. There's been a lot of broadband promises, but at the end of the day, we're lacking in a coordinated, conscious effort to build more homes, he said. And population growth means that we're going to have some competitive challenges ahead of us with real estate prices. Rent prices in Toronto are finally reflecting the very little action that's been going on in the region's real estate market, particularly when it comes to condominiums. Tenants in the city, as well as in others in the region like Hamilton, are now enjoying slightly lower monthly rates for apartments than they were both earlier in the summer and at the same time last year. But residents of nearby locales are not so lucky, as average rent costs are surging hard elsewhere in the province, according to the latest national rent report from Zumper. Released on Thursday, the report shows that median rents in Toronto remain the second highest of metropolitan areas in Canada, though other statistics put Burnaby above us. The average one-bedroom unit in Toronto was 0.8% less expensive in August than it was in July, while two-bedroom units were 0.3% cheaper. Year over year, these numbers were flat and down a larger 2.1% respectively. And though these declines may not seem like much to celebrate, those living in the city of Barrie saw their rent prices skyrocket by double digits compared to August 2023. One-bedrooms in Barrie, which is about an hour and a half from downtown Toronto, will now run citizens a whopping 18.2% more than they did last August. The monthly cost of two-bedroom units is also up by an average of 7.3%. The only other city to see double-digit jumps was Kingston, where rents are up between 13% for one-bedrooms and 16% for two-bedrooms on average, compared to the same time last year. Similar analysis of rent prices across Canada from other sources, like the one published by Rentals.ca and Urbanation on Tuesday, show slightly different prices, with Barrie apartments costing even more, but with a less substantial escalation from last year per their data. That report also showed Ontario rents overall declining an average of 1.5% between August 2023 and August 2024, but includes only purpose-built rentals and condominium apartments, and uses mean averages rather than median. Mortgage borrowers across Canada are likely feeling hopeful. With the central bank's latest interest rate cut, the benchmark cost of borrowing has dropped a cumulative 0.75 percentage point since June, bringing lenders' prime rates, and by extension variable mortgage rates, down with it. But borrowers may be surprised to learn that they won't necessarily get the Bank of Canada's full discount. That's because it's common practice for lenders to slash the spread to prime on variable rate borrowing products when interest rates are trending lower. To understand how this could affect you as a borrower, let's take a look at how variable mortgage rates are priced, which is based on whatever the lender's prime rate is, plus or minus a percentage. For example, let's say you qualify for a 5-year variable rate mortgage rate with a spread of prime minus 1.15%. Assuming the lender's prime rate is currently 6.45%, that leaves you with a rate of 5.3%. Now let's say the Bank of Canada cut its benchmark rate again by a 0.25 percentage point, and the prime rate falls to 6.2%. That same mortgage rate would now be to 5.05%, 6.2, 1.15. But your lender decides to reduce their spread by 20 basis points, meaning their variable mortgage rate is now based on prime minus 0.95. The resulting mortgage rate is now 5.5% for a new applicant, based on a 6.45% prime rate. If there was another 0.25 point cut, the rate would lower to just 5.25%. That may seem like a small difference, but can translate into thousands more paid in interest over the lifetime of the mortgage. Lenders do this for a number of reasons. As a business, protecting revenue comes first and foremost, and when interest rates are already low or falling, they don't need to price as aggressively to win over variable borrowers. The opposite occurs when central bank rates are on the rise. Lenders will improve their spreads to prime to counter waning borrower demand. It's a pattern seen in every rate-cutting cycle, even during the emergency rate cuts at the start of the pandemic lockdowns. This time around, the spread started narrowing in July as the Bank of Canada delivered its second 0.25 point cut. From a borrower's perspective, this seems unfair. But given the economic challenges posed by the large number of mortgages coming up for renewal, it also seems counterintuitive. A total of 2.2 million loans, accounting for 45% of all outstanding mortgages, are coming up for renewal in 2024 and 2025, according to a recent report from Statistics Canada. The report also finds that 1.3 million households bought their first home between 2018 and 2022, when mortgage rates were considerably lower. These borrowers, many of whom are now ending 5-year terms, are renewing in a much higher interest rate environment, This increase in mortgage costs will squeeze households' budgets and savings further, particularly for those that took on large amounts of mortgage debt when the cost of borrowing was low, the report says. An analysis written by Canadian Imperial Bank of Commerce, senior economist Andrew Grantham, raises similar concerns. As a result of rising interest rates, the smallest amount of mortgage principal paid among borrowers has reached a low not seen since 2012. He also finds that today's active mortgage borrowers are also less likely to have a savings cushion to soften the blow of renewing into a higher rate. The saving grace, Grantham writes, is that the current rate-cutting cycle will soften the blow, with perhaps deeper cuts required from the central bank. As interest rates come down, those households that have been incentivized to save more and take on less debt may up their spending and help drive an acceleration in household consumption and residential investment, he writes. However, the wall of mortgages coming up for renewal next year and in 2026 remains a threat, and the Bank of Canada may have to take interest rates slightly below neutral to mitigate the risk at that time. Dwindling spreads will only make it tougher for the central bank to counter this risk. So, as a borrower, what's your move? For those shopping or coming up for renewal, a rate hold is your best bet. This will guarantee you access to the best spreads to prime available today, even as lenders are poised to narrow them further amid future rate cuts. It's a way for variable borrowers to stay one step ahead of the game, a rare opportunity in today's volatile rate environment. Canada's financial watchdog has released a new guide identifying potential red flags for money laundering and tax evasion in the real estate sector. The Financial Transactions and Reports Analysis Centre of Canada, also known as FINTRAC, and the Canada Revenue Agency have published an operational alert to help the industry spot suspicious activities in property transactions that may conceal proceeds from illegal activities, including tax evasion. FINTRAC's guide detailed several methods used to launder money through real estate, such as purchasing properties without using traditional financial institutions or employing straw buyers to obscure the true owner. Straw buyers often lack sufficient income or documentation to obtain a mortgage, which raises suspicions about the legitimacy of the transaction. Straw buyers serve as intermediaries to distance the funds from the ultimate beneficiary and conceal ownership, the alert stated. The watchdog noted that money earned through illegal activities, including drug trafficking, human trafficking, and terrorism, is being funneled into Canadian real estate transactions to mask its origins. Canadian properties, particularly those involved in farming, commercial, industrial, and residential sectors, are considered attractive for money laundering due to the relative ease with which illicit funds can be moved through the market. This is often done by relying on a private lender or unlicensed money services business, FINTRAC explained. Tax evasion can also be facilitated through unsuspecting mortgage brokers, immigration consultants, and the use of trust accounts in tax havens, where funds are used to buy properties without establishing a mortgage or interest payments. The practice of snowwashing, a term used to describe money laundering in Canada, remained a persistent issue. Anti-money laundering experts estimate that as much as $130 billion in suspicious transactions flow through Canada's financial system annually. A 2019 United States State Department report identified Canada as a major money laundering country. FINTRAC's report also highlighted how some developers and builders exploit assignment contracts to evade taxes. This involves reselling a property multiple times before construction is complete, often resulting in unreported profits and capital gains. Another tactic, known as shadow flipping, enables brokers and investors to profit by transferring property before the final sale, avoiding taxes and inflating property prices. The issue of underreporting suspicious transactions by Canada's big banks also remains a concern. Recently, several major banks, including TD Bank, RBC, and CIBC, were fined millions of dollars for failing to report cash transactions over $10,000 as required by the 2001 Proceeds of Crime and Terrorist Financing Act. The Financial Services Regulatory Authority, or FSRA, is sounding the alarm over growing risks in Ontario's private mortgage sector. In its recent private residential mortgage lending report, FSRA raised concerns about the increasing reliance on private mortgages, particularly among borrowers who may not have a clear exit strategy. While FSRA acknowledges the critical role that private lenders play in providing access to credit for underserved borrowers, it warns that the rapid growth of this segment, often catering to higher-risk clients, could create significant challenges for both consumers and the broader financial system if not properly managed. Financially vulnerable individuals may be more impacted by the potential risks of getting a private mortgage, the report notes. As the market share of private mortgage lending has increased over the past decade, FSRA needs to better understand the extent of such risks and consumer behaviors to ensure it has effective supervision strategies in place. One of the major concerns highlighted by FSRA is the lack of exit strategies among borrowers using private lenders. In a January 2023 survey of Ontario homeowners, 43% of those who relied on a private lending company or individual private lender admitted they did not have a plan in place to transition back to a traditional mortgage. This is concerning because this differs from previous observations where private mortgages are typically used for short-term financing until the borrower is able to qualify for traditional financing, FSRA noted. Private lenders, often seen as the lender of last resort, have become essential for borrowers with poor credit, self-employed individuals with variable incomes, and those seeking to finance non-traditional or high-risk real estate. Once a niche market, private mortgage lending has grown rapidly in recent years, driven by rising interest rates, high home prices, and stricter qualification rules from Canada's major banks. While total mortgage originations have dropped significantly since peaking in 2021, private mortgage originations continued to grow, reaching their peak in 2022. As a result, the decline in private mortgage lending has been less pronounced, leading to an increased market share for private lenders. In 2023, private lenders represented 16.8% of all mortgages, up from 13.5% in 2022, according to FSRA. Their share of the total mortgage value also increased, reaching 13.3% in 2023, compared to 10.0% the previous year. Looking at the growth in specific private lender segments, non-individual private lenders saw the largest gain in market share, accounting for 9.3% of the total number of mortgages and 6.3% of total mortgage value in 2023. This marks a significant rise from 2022, when they held 7.4% of the total number and 4.6% of the total value of mortgages. Individual lenders saw their market share in 2023 reach 6.0% of the total number of mortgages and 5.7% of the total mortgage value, up from 4.7% and 4.3%, respectively, in 2022. Investment firms experienced the smallest increase in market share, accounting for 1.5% of the total number of mortgages and 1.2% of total mortgage value in 2023, compared to 1.4% and 1.1%, respectively, in 2022. FSRA has taken several proactive steps to address the risks in the private mortgage sector and ensure better protection for consumers and investors. One of the key measures was the implementation of enhanced licensing requirements for all Ontario brokers and agents involved in private mortgage transactions. These new requirements include mandatory education on private mortgages, designed to increase awareness of the specific risks and complexities associated with this type of lending. FSRA has also made private mortgages a focal point in its recent mortgage brokering sector supervision plans. These plans involved examining brokerages that reported transactions with private mortgage lenders in their annual information returns to ensure compliance with regulations and protect borrowers from potential missteps. The regulator also collaborated with the Mortgage Broker Regulators Council of Canada to develop principles for conducting mortgage product suitability assessments. This collaboration led to the release of FSRA's final Mortgage Product Suitability Assessment Guidance in June 2023, aimed at ensuring consumers receive mortgage product recommendations that align with their financial needs and circumstances. FSRA said it plans to continue monitoring and analyzing Ontario's private lending market, with a commitment to publishing this report annually. Based on emerging trends, whether they signal concern or stability, FSRA will adjust its regulatory approach as needed. FSRA remains committed to protecting consumers through proactive public education, robust industry supervision, and collaborative efforts, it said. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussion both informative and engaging. I'm your host, Steve Hamoan, and we'll see you next time. Stay informed and make well-informed decisions.